Greetings, accounting students et al. Let me preface this video by just pointing out that when I make content, I endeavour to keep it short for the engagement factor. So in this video, the intent is simply to provide a theoretical overview of the balance sheet. We'll touch on definition, the QCs that basically guide the way that the balance sheet is prepared. We'll discuss some of the benefits, but in terms of providing a meaty, practical completion of a classified balance sheet, let's save that for another occasion. So for any of the key theoretical or practical aspects of the VCE accounting course, it's always useful to start with the definition. So therefore, what is a balance sheet? Well, a balance sheet, as we have here, simply provides a statement of the financial position of an entity at a point in time, which is usually the end of the reporting period. So that's our definition, but what about the purpose of the balance sheet? Let's go right back to where we started with accounting conceptually and look at the 4 key stages. So we start with the inputs with our source documents, our EFT, our check butts, receipts, invoices, etc. And then we move to stage 2 where we process them. If we're using a single entry system, we do that via the special journals. If we're doing double entry in the Unit 3-4 course, then we bring the general journal into the mix as well as the general ledger. And then we get to stage 3, the outputs, which are the reports. And in the VCE course, we have 3 key reports. We've got the cash flow statement, we've got the income statement, and of course, we've got the balance sheet. And when we have those outputs, then we get to stage 4, which is where accountants come in. So we can look at our balance sheets and we can evaluate the liquidity through something like a ratio such as the working capital ratio. So that enables us to analyse the firm's ability to pay off short-term debts as they fall due. We can also analyse financial information by looking at multiple reports, the income statement and the balance sheet, and we can look at some of our profitability measures like return on assets, return on owner's investment, etc. Now, what is critical to your understanding of the balance sheet is the accounting equation, A equals L plus OE. And that's really supported visually nicely if we go with a T form of balance sheet, where we list our assets on the left, the debit side, our economic resources controlled by the business as a result of past transaction. And on the credit, the right side, we have our equities, made up of our external equities, which are our liabilities, and then we've got the residual interest, which is our internal equities. Underneath that, our owner's equity. Assets equals the equities of the business, made up of the external claims versus the internal claims. Now, in the VCE course, we classify our balance sheet into current and non-current assets and current and non-current liabilities. So the current assets are expected to be converted into cash or used up within less than 12 months. Likewise, with our current liabilities, we expect to make that sacrifice as a result of an economic obligation within 12 months. It's a bit messy. So for our non-current assets, we expect them to continue to provide an economic benefit for more than 12 months. And if it's a non-current liability, we will not fully satisfy that obligation to the external entity within the next 12 months from the end of the reporting period. Now, let's just quickly touch on the 6 QCs that feature in the VCE course, because they guide the way that we report financial information. So if we look at verifiability, we need to provide evidence of all of our assets, liabilities, our drawings and our capital contribution via source documents. The report needs to be prepared in a timely manner so that the users can interpret the information shortly after the end of the reporting period. The classification of it into current and non-current assets supports the understandability QC, because it makes it easier for the users to interpret. We need to be consistent in the way that we prepare our reports over time to enable the users of reports to compare the financial information contained in the balance sheet from year to year. Relevance, we need to include all relevant information in the report so that users can make informed decisions. And we need to faithfully represent the financial information contained in the report, particularly in the way that we value our non-current assets to reflect real-world events. Now, I did say from the get-go that I'm not going to do a really beefy completion of a balance sheet, but let's just cover a couple of key fundamentals. So when we're reporting information in the balance sheet, we need to remember that every transaction is going to affect at least two accounts, not necessarily on both sides of the balance sheet. Like, for instance, we could have one asset going up and one asset going down. And so therefore assets will change, but will have no effect on the liabilities or the owner's equity. And after every transaction, the accounting equation will always equal, A will always equal L plus OE. The left side of the balance sheet with the assets on the left will always balance with the right side, the equities, the liabilities plus owner's equity. Let's look at a couple of really simple explanations. All right, so for this first one, we've got a capital contribution of 10K plus a 25K vehicle, and we've been asked to show how this will affect the balance sheet. So let's start with our bank balance, which will increase by 10K. So whatever the bank balance was before, we're going to up it by 10 grand. If it was an overdraft, we need to be a bit careful with that because then it's going to be in the liabilities section. We've also contributed a vehicle, so that's going to get listed under the non-current assets. So the impact on our total assets is they've increased by $35,000. Now, there's no effect on the liabilities because the contribution has come internally, not externally. So therefore, we have a capital contribution of those two figures added, 35K. So A still equals L plus OE. The left side of our balance sheet, the debit side, still equals the credit side or the right side of our balance sheet, a $35,000 increase on both sides. So a second example. This time we're purchasing equipment. The source document is EFT, so that's going to affect our bank as opposed to a source document that was an invoice, which would be a credit transaction. And we need to combine these two amounts because they're both paid for in cash. So what's the effect on the accounting equation / the balance sheet? So our bank balance has actually decreased by 44K. We've got more shop equipment. That's what we purchased. So the net effect on assets is our assets have gone down by $4,000. We've had an increase in our non-current assets by 40K, a decrease in our current assets by 44. Hence, we've got a negative $4,000 effect. In terms of our liabilities, there's a GST effect. So because of the GST purchase, that's going to offset the GST we collect from accounts receivable and cash sales. So therefore, it actually decreases our liability. There's no effect on owner's equity because none of this transaction has impacted our residual interest on the assets of the business. So again, in terms of the effect on our balance sheets, we've got both sides decreasing by 4,000. our accounting equation still equals A equals L plus OE.